Hi everybody, and welcome back to this lecture material where we're covering other Solvency II information. So we covered what the three pillars were briefly in the last video. So quantitative requirements is pillar 1, supervisory requirements is pillar 2, including the ORSA or Own Risk and Solvency Assessment document, and pillar 3 is what you need to disclose. What we're going to do in this video is talk about reducing capital required. So there are a couple of ways in which you can reduce the capital that you're required to hold, and so increase your free assets. So we're going to detail these because I think it's important that you know what they are. They do kind of pop up from time to time. They have a significant impact. So the regulations allow companies to apply to use one of two possible adjustments on a single set of liabilities in order to reduce the capital required by the company. They are the matching adjustment and volatility adjustment. So they are quite similar, but they are different things. So let's do the matching adjustment first. So matching adjustment. So where certain assets are used to back certain liabilities, the regulator will allow the BEL calculation to be reduced by adding matching adjustments to the risk-free rates used when calculating BEL. So basically you are allowed, if you've got certain assets and they're backing certain liabilities, to make the risk-free rate bigger, so to make your discount rate bigger. And if you make your discount rate bigger, then your BEL gets smaller. And so that means that when it all kind of works through, your free assets get larger. So although you do it by increasing the risk-free rates, and so that makes BEL smaller, the way you actually show it on the balance sheet is with the original BEL with the risk-free rates, and then the impact of the matching adjustment appears on the asset side of the balance sheet. So that's just how you show it. The best way to think about it is the effect, and the effect is a little bit added onto a risk-free rate makes the discount rate higher, and so the BEL gets smaller. But let's just make a statement about how it's shown. So the impact of this is shown as an asset on the balance sheet. The idea of the matching adjustment is that you benefit from credit spread minus default risk. And it is often used for corporate bonds backing annuity liabilities. So, this is an adjustment. So this is adjustment if you're choosing to hold things like corporate bonds for your annuity liabilities, and it's trying to recognize the fact that those corporate bonds will give you a yield which is higher than government bonds, than risk-free rates on government bonds. And so the regulations are saying that it is okay to get credit for that. And so it is okay for you to end up effectively reducing the amount of capital that you have to hold, because those corporate bonds are going to give you more income than gilts would. So you don't need to hold as much money now. You're going to get more money in the future in some sense. Now, whether you think that this is okay within Solvency II and the philosophy of Solvency II is another question. You know, all the best estimate liabilities are generally calculated using risk-free rates. So this is definitely an adjustment that's used to give a company more capital than it otherwise would. You need to decide whether you want to use a matching adjustment, and you would need to justify to the regulator that you're meeting all the requirements of all the requirements that allow you to use a matching adjustment. But if you pass all of that, then effectively you can reduce, or not effectively, it is true, you reduce the amount of capital that's required in your balance sheet. So that is the matching adjustment, and then there was another one that's called the volatility adjustment, which is similar. So, just wondering whether we should split this into two videos. Should we? Why don't we? Okay, so that's the matching adjustment. We will kind of stop here, put in a break, and then when we come back, we'll do the volatility adjustment.